So, good morning. So, you are to finish now on the ratios. You are to go to the category number 4 of the ratios. So, that number 4 should be profitability ratios. We now go to the profitability ratios and also check what we can get out of it. So let us now note something about the profitability ratios before we look at some questions in relation to that. Let us now check some profitability ratios before we look at a question in relation to that area. So probably we shall just summarize the content of the profitability ratios. We shall just summarize the content of the profitability ratios. So first, we can be able to simplify that. We can be able now to simplify that. We can now be able to simplify that. We can be able to simplify that. These ratios indicates, so these ratios indicates, so these ratios indicates the ability of the company. They indicate the ability of the company. They indicate the ability of the company. They indicate the ability of the company to generate returns, to generate the returns in relation to sales, to generate returns in relation to the sales, in relation to the sales and investment, in relation to the sales and the investment, in relation to the sales and investments. They are classified into two categories as follows. They are classified into two categories as follows. They are classified into two categories as follows. So we start with A. So A will be profitability in relation to the sales. A will be the profitability in relation to the sales. The profitability in relation to sales. Profitability in relation to sales. So we start with number 1. Number 1 under profitability in relation to sales. Number 1 is gross profit margin ratio. Number 1 will be the gross profit margin ratio. So the first one should be the gross profit margin ratio. The gross profit margin ratio. gross profit margin ratio. The first one should be the gross profit margin ratio. So to get the gross profit margin ratio, I will simply be giving the formulas. Then we see how we can be able to apply. So it will be the gross profit divided by the sales. It means the gross profit divided by the sales. Then we show it as a percentage. It will be the gross profit we divide by the sales. Then we show it as a percentage. That's now number one, the gross profit margin ratio. Then number two will be operating profit margin. So I'm simply giving the formula so that we do a question. So number two will be operating profit margin ratio. Operating profit margin ratio. When it comes to the operating profit margin ratio, when you want to get the operating profit margin ratio, it is simply earnings before interest and tax. We divide by the sales. Earnings before interest and the tax. Earnings before interest and the tax. Earnings before interest and the tax. We divide by the sales, then we show it as a percentage. Earnings before interest and tax. We divide by the sales, then we show it as a percentage. So that's now when it comes to the operating profit margin ratio. Then Roman letter 3 will be operating expenses ratio. Roman number 3 will be operating expenses. Operating expenses ratio. The operating expenses ratio. When it comes to the operating expenses ratio, it is supposed to be given by total expenses, excluding interest, total expenses, excluding interest, excluding interest. We divide by the sales. We divide by the sales. We show it as a percentage. Total expenses, excluding interest. Then we express it as a percentage. Then the next one, Roman letter 4. Number 4 is net profit margin ratio. Number 4 will be net profit margin ratio. Net profit margin ratio. So for the net profit margin ratio, it is supposed to be given by earnings after tax, earnings after the tax, earnings after the tax divided by the sales. Then we show it as a percentage. When you want to get net profit margin ratio, is the same as earnings after tax, we divide by the sales. Earnings after tax, we divide by the sales. Then we show it as a percentage. So that was now A. That was meant to be A, and that was about profitability in relation to sales. So now we go to B. We now go to B, which will be profitability in relation to investment. So this one was A, profitability in relation to sales. Now we go to B. B is profitability in relation to investment. The profitability in relation to investment. So we go to B as profitability in relation to investment. The profitability in relation to investment. we check the one for the profitability in relation to investment. Profitability in relation to investment. In relation to investment. So we now check the next one as the profitability in relation to investment. So we are still under number 4, the category ratio number 4, which was profitability ratios. So profitability ratios, we had seen they are classified into 2, profitability in relation to sales, then being, or number 2, profitability in relation to investment. Now we are on profitability in relation to investment. Now we are on profitability in relation to investment. So under profitability in relation to investment, we start with Roman letter 1 as return on investment. Return on investment or return on the total assets. Return on investment or returns on the total assets. Return on investment or returns on the total assets or returns on the total assets. Returns on investment or the returns on the total assets. So when you want to get the return on investment or return on the total assets, so when you want to compute the returns on investment or total assets, it will simply be given by the net profit or earnings after tax. Net profit, it is the net profit or earnings after tax. Net profit or earnings after tax. Then we divide by the total assets. Divide by the total assets. Then we show it as a percentage. We divide by the total assets. Then we divide by the total assets. Then we show it as a percentage. So that is now meant to be what will be a return on investment. Then number 2 will be return on equity. Return on equity or return on the net worth. Return on equity or return on the net worth. Return on equity or return on net worth. Return on equity or return on the net worth. So to get the return on equity or return on the net worth, when you want to compute the return on equity or simply the return on the net worth, so return on equity, it will still be given by net profit. Net profit or earnings after tax or earnings after the tax. Then we shall be required to divide by equity. We divide by equity. We divide by equity. Then we show it as a percentage. We divide by equity. Then we show it as a percentage. Then Roman letter 3, we shall be having it as return on the net assets or returns on the capital employed. Returns on the net assets or returns on the capital employed. Returns on net assets or returns on the capital employed or returns on capital employed. Returns on the net assets or simply returns on the capital employed. So to get the returns on the net assets or returns on the capital employed, to get the returns on the capital employed, it will be equal to net profit or earnings after tax. Net profit or earnings after the tax. Net profit or the earnings after the tax. Then we divide by the capital employed or the net assets. Capital employed or net assets or the net assets like that. Then we show it as a percentage. Capital employed or net assets. Then we show it as a percentage. Then to get the net assets, where net assets, it is simply equal to the fixed assets plus the current assets minus current liabilities. Net assets, it is simply given by the fixed assets plus the current assets, we minus the current liabilities. Then capital employed, when you want to get capital employed. So to get the capital employed, you simply add equity plus the long-term debt. It is simply equity. Then you add long-term debt. So capital employed, it is simply equity. Then we add the long-term debt. So that is now all about that part of the profitability in relation to investment. That was now the profitability in relation to investment. So there were 5 categories of the ratios. So now we got the category 5 of the ratios. So we had already discussed 3 in our previous class. So today we are to discuss the 2 of them. So we have finished the first one. Let us now go to category 5 of the ratios. So category number 5 for the ratios, for those who are in my previous class, we categorize them. Number 5 should be activity or efficiency. Activity or efficiency, or assets utilization ratio. Activity or efficiency, or assets utilization ratios. Activity or efficiency, or the assets utilization ratios. Activity or efficiency, or the assets utilization ratios. Activity or efficiency, or assets utilization ratios. Activity or efficiency, or the assets utilization ratios. The activity or efficiency, or the assets utilization ratios. We look at the activity or the efficiency or assets utilization ratios. So I will simply be able to outline them. Then we simplify on that case. So we start with A. A is the stock or inventory turnover. So A will be the stock or inventory turnover. So A will be the stock or inventory turnover. So A is simply the stock or the inventory turnover. So I'll not be able to explain much about it, but when you want to get the stock turnover, you simply, it is supposed to be given by the cost of goods sold. It It is supposed to be given by the cost of goods sold, cost of the goods sold. Then we divide by the average inventory. Average inventory, like that. We divide by the average inventory. It is simply cost of goods sold. We divide by the average stock or inventory. Average inventory or stock. Average inventory or simply the stock. So normally, you want to get the average. When you want to get the average, you normally take the opening, then we add the closing, then we get the average balance. When you want to get the average inventory, we normally take the opening plus the closing, then we get the average balance. So that is now a stock or inventory turnover. The stock or the inventory turnover. The stock or the inventory turnover. Then B is supposed to be, so B will be the stock or inventory holding period. 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 The stock or simply the inventory holding period. So it will be given by number of days in a year. It is given by number of days. Number of days in a year. Number of days in a year. Then we need to divide by the stock turnover. We divide by the stock turnover. We divide by the stock turnover. But I've already given the formula of the stock turnover. So that means we can also simplify it. Or it can also be given by number of days. Number of days in a year. Remember to multiply by the average stock. We multiply the average stock. We multiply by the average stock. Average stock. Then we divide by the cost of goods sold. We divide by the cost of the goods sold. So when you want to compute what is supposed to be the stock or inventory holding period, we simply get number of days in a year. Then we multiply the average stock. We divide by the cost of goods sold. So this formula, we had already been using it somewhere. Remember when we are calculating the cash conversion cycle. When you are computing the cash conversion cycle, you are able to compute the stock or inventory holding period. So it was meant to be number of days in a year, what was the average stock, then we divide by the cost of goods sold. So, or in case the question gives you the stock turnover, simply take number of days in a year, then you divide by the stock turnover like that. So that is now our number 2, or B, as the stock or inventory holding period. The stock or the inventory holding period. So now we go to C. C will be total assets or investment turnover. 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 Or investment turnover. So total assets or investment turnover. When you want to get the total assets or the investment turnover, it will simply be equal to the sales. It is supposed to be given by the sales. Then we divide by to be the sales. Then we divide by the total assets. We divide by the total assets. We divide by the total assets. So total assets, remember the fixed assets plus the current assets. Total assets is supposed to be the fixed assets will add the current assets. Will add the current assets. We add the current assets. So then now we've got the next one. We need to check the next one, which is supposed to be fixed assets turnover. We got to D as the fixed assets turnover. We got to D as the fixed assets turnover. We got to D as the fixed assets turnover. Even this one, it will be given by the sales. We divide by the fixed assets. It will be given by the sales. Then we divide by the fixed assets. The sales we divide by the fixed assets. Then E is accounts payable. E is the accounts payable or creditors turnover ratio. Accounts payable or the creditors turnover ratio. Accounts payable, accounts payable, accounts payable, or creditors turnover ratio, or creditors turnover ratio. Accounts payable or the creditors turnover ratio. So to get the accounts payable or creditors turnover ratio, it is supposed to be given by the credit purchases. It is supposed to be given by the credit purchases. Credit purchases. The credit purchases. Then we simply divide by average creditors. We divide by the average creditors. Average creditors. We divide by the average creditors. Then we go to the next one, F. F is accounts payable payment period. Accounts payable payment period. The accounts payable payment period. Accounts payable payment period. So to get the accounts payable or payment period, the accounts payable payment period, it will simply equal to number of days in a year. It will be equal to the number of days in a year. As it is given by number of days in a year. It is number of days in a year, number of days in a year. Then we divide by the creditors turnover. 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 So, which means it is also the same as number of days in a year. Number of days in a year. Number of days in a year. Multiplied by the average creditors. Multiplied by the average creditors. Multiplied by then divide by the credit purchases. Divide by the credit purchases. We divide by the credit purchases. We divide by the credit purchases. Then we got the next one. We got the next one, which will be G. G should be accounts receivable or debtors turnover. Accounts receivable or the debtors turnover. Accounts receivable or the debtors turnover. Accounts receivable or the debtors turnover. Accounts receivable or simply the debtors turnover. Accounts receivable. Accounts receivable or debtors turnover. Accounts receivable or simply the debtors turnover. So that one, when you want to compute it, we simply get the credit sales. We divide by the average debtors. It is the credit sales divided by the average debtors. The credit sales divided by average debtors. Credit sales divided by average debtors. Then finally H will be accounts receivable or debtors collection period. Accounts receivable or the debtors collection period. Accounts receivable or debtors collection period. Accounts receivable or debtors collection period. So that one will simply be given by number of days in a year, number of days in a year, then so we multiply by average debtors. We multiply average debtors, then you divide by the credit sales. We divide by the credit sales. So it can also be given by number of days in a year. We multiply the average debtors, then we divide by the credit sales. We divide by the credit sales. So that's now how we shall deal with that. So I want to check some few questions now on those ratios. I want us now to check some few questions on those ratios. On those ratios, because that was what was remaining. That was basically what was remaining. So the first question, we should be able to check on. The first question we can check on. So let us first check the one for the sitting off. Let us check the one for the sitting of May 2018. May 2018. May 2018. Question 5, part C. May 2018. Question number 5, part C. May 2018. Question number 5, part C. We shall first go through the question for May 2018. Question number 5, part C. May 2018. Question 5, part C. So that question for the sitting of May 2018, question number 5, part C, they were saying that Funds Express Limited records got lost in a fire that burned down the accounts office. That had burned down the account office. Then the following information was, however, obtained from the laptop of the accountant for the year ended 31st December 2017. So you are given the opening stock turnover ratio. Then they also gave you the net profit margin, then also gross profit margin, current ratio, long-term loan. You are also given depreciation of the fixed assets, the closing stock. So additional information, credit period allowed by the suppliers is 1 month. Average debt collection period is 2 months. Then on 31st December 2017, current assets consisted of stock, debtors, and cash only. There was no bank overdraft. All purchases are made on credit. So cash sales were 1/4 of the total sales. So required Roma letter 1, they wanted you to compute the cost of sales. They wanted you to compute the figure for the cost of the sales. Then Roma letter 2, gross profit margin, total sales, total purchases, net profit, debtors value, and creditors value. So let us see how to get the cost of sales. Let us see how to get the cost of sales. So to get the cost of sales, the question had given you something about the stock turnover ratio. The question has given you the stock turnover ratio. The question has given you the stock turnover ratio. So we shall be able to apply that ratio of the stock turnover ratio and see what we can be able to get out of it. So to get the stock turnover ratio, when you check under the ratios number 5 I've just given you today, I gave you a ratio of the stock or inventory turnover. I gave you a ratio. So under the activity or efficiency or assets utilization ratio, there is a ratio known as the stock or inventory turnover. The stock or inventory turnover. The stock or simply the inventory turnover. So here they calculated the ratios. Now you use the ratios, you calculate the items which are missing. So when you check through that formula, the stock or inventory turnover, the stock turnover ratio is supposed to be given by the cost of goods sold, the stock turnover ratio. So the stock turnover ratio, it is supposed to be given by cost of goods sold. Cost of goods sold, we divide by the average stock. We divide by average stock. So cost of goods sold, we make the cost of goods sold to be the subject. Cost of goods sold to be the subject. So it will be given by average stock. It will be given by the average stock multiplied by the stock turnover ratio. Multiplied by the stock turnover ratio. The stock turnover ratio. So normally to get the average stock, inventory is the stock. The question gave you the opening stock. When you check down there, it is 450. 450. And the closing stock was also given at the same area. At the end of that area, you can see the closing stock, 510. You can see the 510. So when you divide this by 2, that is what we give you, the average stock. Then the question gave you the stock turnover ratio as 10. So multiply by 10 like that. So that should be able to give you, that is meant to give you what should be. So that is meant to give us what should be the cost of goods sold. 480 for the average stock. For the average stock, and when you multiply 10, it should give us which figure? 4.8. Yeah. So those who are online, I hope you are getting 4.8. Unapata 4.8. Those who are online, yes, 4.8 millions. So that is now the Roman letter 1, how you are to get the cost of sales, how you are meant to get the cost of sales. Then Roman letter 2 is the gross profit. Roman letter 2, they want you to get the gross profit. So to get the gross profit, the question gave you the gross profit margin. The question had given you the gross profit margin ratio. The question had given you the gross profit margin. The question had given you the gross profit margin. The question had given you the gross profit margin. So normally, to get the gross profit margin, I gave you some formulas for that. The gross profit margin. So gross profit margin. Gross profit margin ratio. It is supposed to be given by the gross profit. The gross profit divided by the sales. Then we show it as a percentage. So when you want to get the gross profit margin, it is supposed to be given by what is supposed to be the gross profit. We divide by the sales, then we shall be able to express it as a percentage. We shall be able to express it as a percentage. So in that question, in that particular question, remember, you are also given the issue to do with the cost of sales. So normally, when we take the sales minus the cost of sales, we normally get the gross profit. We normally get the gross profit. So we calculated the cost of, so we shall not be able to use this formula. But what I want you to understand is that when we take the sales revenue minus the cost of sales, we get the gross profit. When you take the sales revenue, then when you minus the cost of sales, we shall be able to get the gross profit. So the cost of sales we calculated, we got 4.8, isn't it? Yeah, so normally, when you take the gross profit, so gross profit is also the same as the sales revenue, minus the cost of the sales. So the gross profit margin, they have given us a percentage for that. The gross profit margin, they have given us a percentage for it is 20%. So when this one is 20%, it means this one must be 100%. Then this other one must be what? 80%. So we have already seen the cost of sales. If you remember, the cost of sales was 4.8 million. I suspect that's what you got. Yeah, so 4.8 million is equivalent to 80%. Is equivalent to 80%. So what should be the figure for the gross profit? So gross profit is meant to be 20%. So now, what should be, when we cross multiply, what should be now our gross profit? So just cross multiply and see what figure are you going to get for the gross profit. $1.2. So I'm told it is 1.2. It is 1.2 million. It is is 1.2 millions. So that's now our Roma letter 2, how to get the gross profit. Then from there we go to Roma letter 3, how to get the total sales. So total sales, we can do the same. You want also to get the total sales. We also want to get the total sales. So to get the total sales, we also say that 4.8 million is 80%. How about 100%? Or simply add the gross profit and the cost of sales. Or you simply add the gross profit plus the cost of sales. You'll be able to get the sales revenue. You will be able to get the sales revenue. So how much will be our sales revenue? Our sales revenue should be how much? 6 millions. Those who are online, sales revenue should be 6 million. So that was now your Roma letter 3, total sales. So Roma letter 4, they wanted you to get the total purchases. Roma letter 4, they wanted you to get the total purchases. So also to get the total purchases, also when you want to get the total purchases, for us to get the total purchases, we still use the cost of sales. We still use cost of sales. So cost of sales is supposed to be equal to the cost of sales. It is supposed to be given by opening stock, opening stock plus the purchases. We add the purchases, then we less the closing stock. We minus the closing stock. So we make purchases to be the subject. When we make the purchases to be the subject. So those purchases will remain this side. I make the purchases to be the subject. So cost of sales will remain, so it will be equal to the cost of sales. So opening stock, when it grows, will be a negative. So we minus the opening stock. We minus the opening stock. Then we add this one, when it grows, it will be a plus. We add the closing stock. So cost of sales we computed, was it 4.8 million? Cost of sales. It was 4.8 million. Opening stock was also given. It is 450,000. So opening stock was given to you as 450,000. So we minus 450,000. We less. The grossing stock was 510. The grossing stock was 510,000. 510. So get that figure for the purchases. Get that figure for the purchases. So how much will be the value for the purchases? So someone has given me 4.86 million. So I can see 4.86 million. Is it 4.86 or 4.68? I've seen last year you are giving me 4.68. Is it 4.6 or 4.86? Yeah, 4.86. So that is now our Roman letter 4. So we go to Roman letter 5, net profit. Roman letter 5, we compute the net profit. We go to the Roman letter 5. How to get the net profit? We need to see how to compute the net profit. So to get the net profit, we use the net profit margin ratio. Net profit margin ratio. Remember, it is supposed to be given by the net profit. Net profit divided by the sales. Then show it as a percentage. So that means to get the net profit, it will simply be given by net profit margin ratio. The net profit margin ratio multiplied by the figure for the sales, multiplied by the value for the sales. So net profit margin ratio, they were able to give you 15%. They were able to give you 15% of the sales. Sales, we said, was it 6 million? The sales revenue, was it 6 million? Yes. Yeah. So now from there, you should be able to come up with the net profit. We should be able to get the net profit. 0.9 million. So now we go to Roman letter 6, debtors value. They want you to get the debtors value. So to get the debtors value, you go to the note number 4, not note number 4, but note number 2. To get the debtors value, go to the note number 2. Average debt collection. That's the same as the average debtors collection period. Average debtors collection period. We check the average debtors collection period. Average debtors collection period. So average debtors. Average debtors collection period. Average debtors collection period. It is normally given by number of days in a year. It is supposed to be given by number of days in a year. Number of days in a year. We multiply by the average debtors. We multiply by the average debtors. Then we divide by credit sales. We divide by the credit sales. We divide by credit sales. So we make the average debtors to be the subject. We make, because they wanted you to get the debtors value. So when we make the average debtors to be the subject, it will be equal to the credit sales. It will be equal to the credit sales multiplied by average debtors collection rate. Average debtors collection period. Average debtors collection period. Then we divide by number of days in a year. Number of so when you check in the note number 6, when you check the note number 6, they were able to say that cash sales were a quarter, which means the credit sales will be what? 3/4. So you compute the credit sales. You get the credit sales. It will be 3/4 multiplied by 6 millions. Because we know our sales were 6 millions. Our sales were 6 millions. So we get 3/4 of the 6 million. Will it be 4.5? Is it 4.5? Yes. Yeah, so now you will be taking the 4.5 million. Average debtors collection period. You see they gave you in the note number 2. Are you able to see note 2? Average debt collection, they gave us what? 2 months. So that means we use the month. These are 2 months. Those are 2 months. The number of the month in a year, 12. So divide by 12 months. It has been given in terms of month. So because it was given in terms of month, we multiply 2 months, then we divide by 12 months. 0.75. So that was now how to get the average debt. So we assume the average debtors is the same as the debtors value, because you are not given information about the opening and the closing. So we simply assume that as the debtors value. So finally, we got the last one. They wanted you to get the creditors value. So to get the creditors value, you use the note number 1. Credit period allowed by the suppliers. That's the same as the creditors payment period. So that Roman letter 1. So that Roman letter, the last note number 1 is the same as the creditors. The creditors payment period is the same as the creditors payment period. So when it comes to calculating the creditors payment period, when it comes to computing the creditors payment period, so when it comes to calculating the creditors payment period, so creditors also, or creditors collection period, or the creditors collection period in days. The creditors collection period in days to also be given by number of days in a year. Number of days in a year multiplied by the average creditors multiplied by average creditors. Then we divide by the credit purchases. We divide by the credit purchases. By the credit purchases. We divide by the credit purchases. So there's a time you are computing the cash conversion cycle. So I hope all of you are in my class. We had made a small mistake on that formula. I want you to correct that formula. We were dividing by the cost of sales, but that was not the case. It should have been the credit purchases. I hope all of you are getting that part. We had been using this formula, but we were dividing by the cost of sales. So you make that correction. You are supposed to divide by the credit purchases. There was a mistake we were making in that format. I discovered after the class, but I knew we should meet again. So I want you to make that correction when you are calculating the debtors, the cash conversion cycle. So where there was the creditors collection period in this, I remember we were dividing by the cost of sales, but that was not the case. You go back and make that correction. You will be dividing by the credit purchases. I hope it is clear to all of you. I want us to agree on that. Is it clear to all of you? Wale mko online. Tunaelewana hiyo? Yeah, go back to where we were calculating the cash conversion cycle. There was a mistake we were making on the creditors collection period in days. I discovered that later, but now you can make a correction for that. Instead of the cost of sales, we divide by what? The credit purchases. We divide by the credit purchases. So now we can finish off our question. Using question 17. Sorry? Question 11. Yes. Yes. You should be able to make that correction. So let us now finish off this question. They have said, so we make the average creditors to be the subject. We make average creditors to be the subject. We make the average creditors to be the subject. So when we make the average creditors to be the subject, it will be given by the credit purchases, to be the credit purchases multiplied by creditors collection period, the creditors collection period, the creditors collection period. Then remember to divide by number of days in a year. Number of days in a year. By number of days in a year. So in the note number 5, we say all purchases are made on credit. All purchases were made on credit. We calculated the credit, the purchases. Was it 4.5 million? Yeah. Our purchases, just confirm. We calculated, I don't think it was 4.5. Just confirm, was it 0.9 million? We calculate the purchases in the Roman letter 4. 4.86. It was 4.86 million. So you take 4.86 million. Creditors collection period in the note number 1. Credit period allowed to the suppliers is 1 month. So we are doing month multiplied by 1 month. Then divide by 12 months. Those are the number of the month in a year. We divide by 12 months, which is meant to be the number of the month in a year. Zero point four. 0.405 million. So we are simply doing questions on the ratios, because now that we have discussed what we mean by this. So we go to another question, May 2017. May 2017. Question number 4, part A. May 2017. We check question number 4, part A. May 2017. We check question number 4, part A. May 2017. We check question number 4, part A. So when you check through the question for May 2017, when you check through the question for May 2017, May 2017, So let us go through the question number 4, part A. So that question 4, part A for May 2017, they were simply saying that the following are the summarized financial statements for Pocosa Limited. So Pocosa Limited statement of the financial position as at 31st December was given. So they gave you 2015 and also 2016. They gave you 2015 and also 2016. Then they gave us details concerning the current assets, then total assets. We also have the current liabilities, then long-term liabilities, the long-term liabilities. They also gave you equity, then that part of the called up share capital, that area of the called up share capital of shillings 0.25 per share. So that part will assist you to get the number of the ordinary shares. It will assist you to get the number of the ordinary shares. So you see, like now, 2015, the called up share capital is 9,920,000. So the bar value is 0.25. So when you take that figure, divide by 0.25, you will get the number of the ordinary shares. We shall be getting the number of the ordinary shares, then retained earnings, then the shareholders' funds. Then Pocosa Limited income statement for the year ended 31st December 2015, and it was given revenue, operating profit, interest payable, profit before taxation, profit for the year. So now additional information notes. Note number 1, retained profit brought forward, then also dividends paid during the year. Dividends paid during the year. So now required for each of the 2 years, they wanted you to calculate the following. For each of the 2 years, they wanted to calculate the following. Roman letter 1, earning per share. Roman letter 2, dividend cover. Roman letter 3, current ratio. Roman letter 4, asset test ratio. And also return on capital employed. So we start by computing the earning per share. We start by computing the earning per share. So for us to get the earning per share, when you want to get earnings per share, so when you want to compute earnings per share, earnings per share is supposed to be given by earnings per share is supposed to be given by the earnings available. Earnings available, we divide by number of the ordinary shares. So to get the earning per share, it will be given by earnings available, we divide by the number of the ordinary shares. So earnings available is the same as the profit for the year. That is the profit after the tax. Earnings available is the same as the profit after the tax. It is the same as earnings after the tax for this question. The profit for the year. But if there were preference dividends, we normally subtract the preference dividend to get the earnings available. So let us first calculate the number of the ordinary shares. Number of the ordinary shares. They were not given. The number of the ordinary shares were not given. So we check under the called up share capital. So they were the same for both cases. It is 9,920,000. So divide by 0.25. Divide by 0.25 and see how many shares are we going to have at that point. Yes, just use the full figure, 9,920,000 divided by 0.25. So how many shares are there? 68. 39.68. Those who are online, 39.68 millions. I can see 39.86 millions. So now we got to, we want to get the earning per share for 2015. Earning per share for 2015. So to get the earning per share for 2015, the question had given you the profit for the year or earnings after tax. So this one was 9,520. So there are 3 zeros at the top.
68, not 80.
Sorry. This one's 39.68. So we do the same for this one. That's 9,680. So that should be able to give you the earning per share for that. That is for 2015. We also go to earning per share for 2016. Earning per share for 2016. So you do the same. You take the profit for the year. So number of the shares are the same for both cases. 11,616. Is it 660 for 2016? Earnings. Earnings are, is it 11,660 or 11,600? Under the revenue.
11,660.
11,660. So you also divide by 29,680. So the number of the ordinary shares are the same. So that was now how to compute the earning per share for that. So we now go to Roman letter 2. Roman letter 2 is about the dividend cover. Roman letter 2 is about the dividend cover. So dividend cover, we discussed that. We discussed that under the valuation ratios. We discussed that under the valuation ratios. Dividend cover is supposed to be given by earning per share, or simply earnings available divided by the total ordinary dividend declared and paid. So dividend cover is supposed to be given by, so if you recall the notes I gave you under the valuation ratios, dividend cover is supposed to be given by dividend cover is supposed to be given by earnings available, earnings available. Then we divide by the dividends declared and paid. Dividends declared and paid. Or alternatively, it is also the same as earnings per share divided by dividend per share. So it can be given by earnings available divided by the dividends declared or paid. So we start with the one of 2015. We start with the one for 2015. So we just use the earnings available, which is the profits for the year. So profit for the year, this was given as 9,520,000. So dividends declared is down there under the notes. You can see the notes, note 1, dividend paid during the year. So under the 2015, it is 2.24 millions, 2,240,000. So that should give you the dividend cover. It is normally given in terms of the number of times. Then there is also the one for 2016. So when it comes to 2016, it will also be 11 millions. Also divided by 2.4. So that is now for the dividend cover. That is now meant to be for the dividend cover. Yeah, so the first one is giving us how many times?
4.25.
Yeah, and then the second one is
0.4833.
So that's now how to compute a dividend cover. So let us now go to Roman letter 3, current ratio. We go to the Roman letter 3 about the current ratio. So to get the current ratio, those are the ratios about liquidity ratios. Those are the ratios about liquidity ratios. Current ratio is simply equal to the current assets divided by the current liabilities. Current ratio will simply be equal to the current assets divided by the current liabilities. So current ratio will simply be equal to, so current ratio is simply the current assets divided by the current liabilities. So that was about liquidity ratios. We discussed that. So we start with the one for 2015. So current assets, you are given, when you check there, they were able to give you current assets, inventory, accounts receivable, and cash and bank. So that total is 92. Are you able to see 92? 447. That one is given. There are 3 zeros at the top. Current liabilities, you also check, there are also only 2. Accounts payable and taxation, and they gave you 36,862. 36,862. Then you do the same for 2016. The same for 2016. When it comes to 2016, current asset is 99,615. 99,615. also divide by, we should also be able to divide by 42 for 75. 42 for 75. So that is now under the 2016.
First one is 2.508.
2.508.
The other one is 2.345.
So, yeah, so that is okay. So we now check the Roman letter 4. Roman letter 4 is acid test ratio. So when you want to compute the acid test ratio, when you want to compute the acid test ratio, it is the same as this one, but now you only subtract stock from that. So acid test ratio will simply be given by current assets minus the stock. We divide by the current liabilities. Current assets minus the stock. We divide by the current liabilities. So the same formula that we have just used, we only subtract stock. Stock is the same as inventory. Stock is the same as inventory. Stock is the same as inventory. So when you check under 2015, so yeah, they gave me 40.145, so you minus 40.145 like that. So also this one, you minus 50 for 55. Then get those ratios. Get those particular ratios.
First one is 1.419,
The second one is
20.267.
so that's now how you are to deal with that. So finally, we check the last part, which is supposed to be return on the capital employed. We now check the last part, which is meant to be the return on the capital employed. We now check the return on the capital employed. So returns on the capital employed we discussed today, that was the profitability ratios. So when you check profitability in relation to investment, there is returns on the capital employed. So returns on the capital employed. Yeah, so we check that portion, the returns on the capital employed. So we now check something brief on the returns on the capital employed. So to get returns on the capital, returns on the capital employed. The notes I gave you today, it was supposed to be given by earnings after tax divided by the capital employed or net assets. Earnings after tax, earnings after the tax, return divided by net assets or capital employed or the capital employed, or the capital employed. Then you are showing it as a percentage. Then you are showing that information as a percentage. So when you check through the question, like now, net assets, we say it is fixed assets plus the current assets minus the current liability. Capital employed or simply equity plus the long term, that all of them should be the same. All of them should be able to give you the same figure for that. So we start with the one for 2015. So earnings after tax is the profit for the year. The profit for the year, it is 9, 20. So net assets or capital employed. So net assets, take the total assets minus the current liability. They gave you that liability.
Yes.
Should we which value? Then we minus the, so 97, 442. 97, 442. Then subtract the current liability. Current liability is 36.
862.
36, 862. Then you will show it as a percentage. We do the same for 2016, whereby you will also be able to take 11,660. So when you check over there, the assets, you are 112, 315. Then also subtract the current liabilities, which are 42, 475, 42, 475. So you express them as percentages. So you express them as the percentages. So 2015, someone has given me 15.7%.
Yes.
How about 2016?
1.66.
Okay. So now, apart from that question, now I want us to go back and check the other question. So the other question I would like us to go through. There is a question in the sitting of November 2018. November 2018, question number 4, part A. 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 So when you check November 2018, question number 4, part A, they were saying that the following are the financial statements of ABC Limited and XYZ Limited for the year ended 30th September 2018. So we are looking at the question for November 2018, question 4, part A. The November 2018 question 4, part A. So they gave you income statement, revenue up to the end, where they gave retained profit carried forward. Statement of the financial position was also given for all of them. So required Roman letter 1, vertical common size statement of income for the year ended 30th September 2018. Roman letter 2, vertical common size statement for the financial position as at 30th September 2018. So the concept I want you to understand, when it comes to the income statement, all the items in the income statement are expressed as a percentage of the sales. You see that part? Yeah, when they are about the vertical common size statement for the income, so we represent all the items. We represent all the items in the income statement. We represent all the items in the income statement as a percentage of the sales, as a percentage of the sales. As a percentage of the sales. So all items in the income statement will be expressed as a percentage of the sales. That's what you mean by, so maybe you can just explain what we mean by the common size income statement. So we can first note that the common size income statement, let us note something brief by summarizing that. The common size income statement, the common size income statement is the income statement, is the income statement, is the income statement where each item, in the statement, where each item in the statement is expressed as a percentage of the sales, is expressed as a percentage of the sales, is expressed as a percentage of sales. Therefore, the vertical common size statement, the vertical common size statement is used for comparison. It is used for the comparison. It is used for the comparison. It is used for comparison when measuring performance. It is used for the comparison when measuring the performance. When measuring the performance. Yeah, so that question is very simple. You just present it in the same format they have given you, but all the items are represented as a percentage of the sales. All the items will be presented as a percentage of the sales. So what you do, you compute for ABC and also XYZ limited. ABC limited, ABC limited, and also XYZ limited. So I'll just do a few because the statement you express each item as a percentage of the sales. You express each item. So start with the first one. So the first item is the cost of sales. Is the cost of the sales. So the figure for the cost of sales, you can see it is 3 millions under 20, so under ABC. Consider 3 millions. So divide by the sales revenue. You can see the revenue is 4 millions. Or we then express it as a percentage. You get the value for that. When it comes to XYZ, you do the same. 4.8 millions. 4.8 millions. You also divide by the sales, which is 6 millions. Then you show it as a percentage. Then you show it as a percent. That's now the first one. You got the second item, which is the gross profit. You got the second item, which is the gross profit. So even for the gross profit, it is 1 million. You take that 1 million. Sales will remain 4 million. Show it as a percentage. Even the other one is 1.2 millions. 1.2 millions. Also divide by 6 millions. Then you show them as a percentage. So you show all those items. The next one is distribution cost. There is distribution cost. There is the distribution cost. The fourth one is the administration cost. Administration cost. The fifth one, every item we divide by the sales. The fifth one is the finance cost. The finance cost. Number 6 should be the profit before the tax. The profit before the tax. Then number 7 should be the tax paid. Then number 8 should be profit after the tax. Number 9, we'll have it as dividend paid. Then number 10, we'll be having retained profit for the year. Retained profit for the year. And number 11, we'll have the retained profit brought forward. the last one, number 12. Carry forward like that. So you just present all those items as a percentage of sales. All those items, you express them as a percentage of sales. You take each one of them, divide by the sales, show it as a percentage of sales. So you will finish. Let us now check the other one, the Roman letter 2. So that other one you'll be able to finish. Let us check the Roman letter 2. So Roman letter 2 was meant to be vertical common size statement for the financial position. So I want us to note something brief about what they mean by the vertical common size statement for the financial position. So it is similar to the one for the income statement, apart from the few items in that area. So for that Roman letter 2, we can note that this involves the analysis. Of the balance sheet items. And we continue by noting that where all the balance sheet assets all the balance sheet assets, all the balance sheet assets items, all the balance sheet assets items, all the balance sheet assets items are expressed as a percentage, are expressed as a percentage of the total assets, are expressed as a percentage of the total assets. They are expressed as a percentage of the total assets. Then you compare by noting that a new paragraph is that the current liabilities, comma, long-term debts, the long-term debts, and equity items. Current liability, comma, long-term debts and equity items are expressed as a percentage of the total liabilities and equity, are expressed as a percentage of the total liabilities and equity. All the current liabilities, long-term debts and equity items are expressed as a percentage of the total liabilities and equity. So the concept is still the same, but now remember that when you are dealing with so this should be the balance sheet or the statement of the financial position. Balance sheet or the statement of the financial position. The balance sheet or simply the statement of the financial position. So what you do for that, you check down there, you start with the land and the buildings. So you start with the land and the building. The first item will be land and buildings. So you take that item, which is 1.2 millions, you divide by the total assets. So total assets, are you able to see 3.15? Total assets, they are 3.15. So divide by 3.15 millions, you show it as a percentage. We do the same for XYZ Limited, where it is 5 millions. You also divide by 7.88. So that's now for the assets. All of them, you show them as what? A percentage of the total assets. So when it comes to finance by, so you will do that for all of them, isn't it? There is furniture and fittings, there is inventory, there is trade receivable, there is financial assets, and also cash at what? At bank. Then when it comes to under-financed by, you can see under-financed by, you start with the ordinary share capital. So I've jumped there, you will finish that, all those other items. So the other one, when it comes now to financed by, so this one I can have it as the one for the financed by. When it comes to the one for the financed by, you start with the ordinary share capital. You start the ordinary share capital. So for this one, you take the figure for the ordinary share capital, which is 1 million, then you divide by the total. But the total will just remain the same. So it is also 3.15. Yes. Yeah, 3.15. But this one, it is current liabilities, long-term liabilities, and what? equity, but they will add up to be the same item. Yeah. So that is what I wanted you to know. So that part you finish. You will finish all of them. There is nothing complicated in relation to that. They are only meant for the comparison purpose. So you are saying that we will finish by 10:30. It is just 3 minutes to that time. So we have almost finished that part of the ratios. That is what I wanted you to go through. So in case I get some other time, I will also arrange we meet, but that one I will simply be talking about some few questions, then we finalize on that level. But now we have concluded that part of the ratios. So go through them and see how they can assist you for the purpose of the exam. They have not tested the ratios for some time, like almost more than 3 sittings, they have not tested anything on the ratios. That's why I was concerned to see whether we can finish that. So go through them and see what you can get from there. So let us stop there for today. So you can stop there.